The news highlights a significant downturn in U.S. stock markets, marking the worst week for equities since the onset of the COVID-19 pandemic. This decline is attributed to the reintroduction of a 10% tariff on goods imported from the UK, a policy decision made by former President Donald Trump. The tariffs are likely to raise costs for US companies that rely on British imports, potentially leading to higher prices for consumers and squeezing profit margins for businesses. Investors often react negatively to such trade barriers, fearing that they could disrupt supply chains and hinder economic recovery, especially in a post-pandemic environment. The combination of these tariffs and broader economic uncertainties may have contributed to a sell-off in stocks, as market participants reassess the outlook for corporate earnings and economic growth. This situation underscores the ongoing volatility in global markets and the potential impact of trade policies on investor sentiment. The situation reflects a complex interplay between trade policies and market dynamics, where the reintroduction of tariffs can create ripple effects throughout the economy. Analysts may be concerned about the implications for US-UK trade relations, as these tariffs could lead to retaliatory measures or further strain diplomatic ties. Additionally, the timing of this news is critical, as it comes during a period when many investors are already wary of inflationary pressures and supply chain disruptions. The stock market's reaction could also be influenced by broader geopolitical tensions and the ongoing recovery from the pandemic, making it a pivotal moment for both investors and policymakers. As the market adjusts to these developments, it will be essential to monitor how companies adapt to the new tariff landscape and whether consumer behavior shifts in response to potential price increases. The implications of these tariffs extend beyond immediate market reactions, as they may also affect long-term investment strategies. Companies may need to reevaluate their sourcing and supply chain strategies to mitigate the impact of increased costs. This could lead to a shift in trade patterns, with businesses seeking alternative suppliers or adjusting their pricing strategies to maintain competitiveness. Furthermore, the uncertainty surrounding trade policies can lead to increased volatility in the markets, as investors react to news and developments in real time. The potential for retaliatory tariffs from the UK could exacerbate tensions and create a more challenging environment for international trade. In this context, analysts will likely focus on sectors most affected by the tariffs, such as consumer goods, manufacturing, and technology, to gauge the broader economic impact. The situation serves as a reminder of the interconnectedness of global markets and the importance of trade relations in shaping economic outcomes. As the situation evolves, stakeholders will need to stay informed about policy changes and the potential ramifications, both domestically and internationally. The ongoing dialogue around tariffs and trade agreements will be crucial in determining the future landscape of US-UK relations and the overall health of the global economy.